All right. Cool, cool. All right. So, first of all, I want to thank all of you for joining today. Nice big group here. But I really want to thank you all for taking time out of this evening, whether it's storming where you're at or snowing. Thank you for giving me your time. And I'm looking forward to kind of adding value to everybody here today. So, as we all know, what you signed up for, right? Signed up for the small business tax updates, right? So the point of this presentation is to essentially give you all some tax updates, not only just for 2024, right? So for this upcoming tax season, but for my new business owners here, right? I want to give you all like a high level overview of taxes and kind of do a brief introduction, right? So before I get started, there are a couple people in here that I haven't met before. So if you were at a presentation recently, you got to go through my spiel again. So my name is Darion Wiggs. I'm a licensed certified public accountant, and I'm the CEO and founder of Wiggs CPA Tax and Accounting. Now, Wiggs CPA Tax and Accounting is a relatively new firm. We were launched on October 20th, 2022. So we're about 14 months old. But the beautiful thing about that is I've had the pleasure to work with hundreds of people over the last few years. So trust me when I say you're in good hands. So Wiggs CPA Tax and Accounting, we specialize in working with small business owners. We do individual taxes, but mostly we specialize in working with small business owners who pretty much need a CPA on their team to handle their bookkeeping, finances, and all the financial headaches that come with having a small business, as you can imagine, right? So as far as formal education, I did graduate from the University of Illinois at Urbana-Champaign. I got my bachelor's degree in accountancy, and then for some reason, I stayed an extra year and got my master's degree too as well in accountancy with a concentration in real estate, right? So after graduating, I started off as an auditor at Ernst & Young. And for those who don't know, that's like the third largest accounting firm in the world. And for me, coming from the south side of Chicago, south suburbs, I thought I landed my dream job. I worked my entire life to get to college. Got a full ride scholarship. Shout out to Mrs. High on the call who helped me get the scholarship. But I went to the University of Illinois and I started off working downtown Chicago and I thought I had made it. But honestly, y'all, and a lot of y'all probably haven't went through this, going from being a W-2 employee to a business owner. I went through that phase very, very early on in my career, and I just didn't feel like that was a good fit for me and for my long-term goals. So I made a pivot, right? I left this job I was at, and I risked it all during the pandemic, and I went on, and that's when I discovered entrepreneurship, right? It was never part of the plan. But once I discovered that I would be able to be in a position to do things like today and actually be able to teach and give value back to the community, I was all in. So here we are today. So that's what I love doing, y'all. Taxes is something I fell in love with over the last year. Never thought I would say it. Just because of the fact that I've learned how to save people money, and I know money and taxes in general can add a huge strain to our lives. So I'm really excited, super passionate about teaching, and hopefully this presentation will increase everybody here in terms of your financial literacy and add some type of value to your life. So let's get started. So enough about me. Let's just jump into the agenda, right? Let's get this presentation going. So high level overview of what we're talking about. We're going to go over the difference between being taxed as a W-2 employee and a business owner, right? A lot of you are business owners, and a few of you are in a point where you're having a hobby or you're about to be a business owner. So I'm going to keep that part kind of quick, right? The next part is business entity formations, going over LLCs and corporations, tax deductions after that, bookkeeping best practices, and then the Corporate Transparency Act. So if you fall asleep at some point throughout the presentation, set our alarm for 30 minutes and wake back up at the end, right? So we're going to try to prevent that from happening, but this is a quick kind of high-level overview of what we'll be discussing. So let's dive in, right? So whenever I talk about taxes to anybody, right, taxes comes off, one, as a boring topic, and two, it's something that we don't necessarily get taught in school. I'm a CPA. I went to the #2 accounting program in the nation, and I kid y'all, I've never learned about most of the stuff I'm about to tell you about right now. So when I start teaching people about taxes, and when I learned about taxes, it essentially starts off with a mindset shift, y'all. We need to know how to essentially figure out a way to legally use the tax code so that we can learn how to live tax-free, right? But in order to do so, we got to understand the importance of it, right? Because the truth is, right, when you look at your state tax rate in Illinois at 5%, your federal tax rate 24%, self-employment tax 15%, all of that together is about 35, 40, and some of us even higher. But 40% of your income on average, as you increase in these brackets, are going to the IRS. So that's super important because the easiest way to save money is to pay less in taxes. So this is super important because I want to teach you all how to legally avoid paying taxes. But first, it's a mindset shift because you have to understand that the tax code wasn't made for W-2 employees. It was made for business owners and investors. And because you're here today, I'm assuming that's you. So let's figure out how we can basically use this code to our advantage, especially as the IRS continues to pump more money into auditing small businesses. The whole point of this presentation is to make sure that we're making sure we're staying compliant from all levels so we don't have to worry about Uncle Sam knocking on the door, right? So first thing I always go over, this is my big example, right? My favorite example, especially for those of you who are making the shift from being a W-2 employee to a business owner, or you just don't understand business taxes at all. I'll fly through this because I know a couple of y'all already been in this position before, right? But when you look at it, right, when I say the tax code wasn't made for W-2 employees, I just basically mean that they're taxed completely different than business owners. And the reason why is because if you are a W-2 employee, you make money, the IRS takes money, and then you get to spend what's left, right? So in this case, you got somebody making $100,000 as a W-2 employee, $100,000 as a business owner. And let's just assume a tax rate of 25% for the example, right? If you're a W-2 employee making $100,000, you're not really making six figures. You're not really making $100,000. It looks good on paper, but we all know when you get that check stub and you see how much you get to take home, Uncle Sam gets his money first. So in this example, you made six figures on paper. Uncle Sam took $25,000, and now you get to spend what's left. That's your spending money. That's $75,000. But as a business owner, the reason why I say the tax code is made for business owners, not only does the government incentivize us by giving us tax deductions and credits, which we'll talk about, but in this case, you're a business owner. You're making six figures. You make $100,000, the same amount as your W-2 employees, right? However, the equation is different. You see, if you're a business owner, you can make six figures, but you don't pay taxes on six figures. You pay taxes on what's left. You make money. You get to spend money on anything that's ordinary and necessary to operate your business, and then you pay taxes on what's left. So in this case, you made $100,000, but you're a business owner. You get to write off all type of stuff, and we're going to talk about it soon. We're not just talking about meals and travel and phone bill and internet, right? That's just the basics. But if you do this the right way, you'll have enough expenses to wipe out your income completely, and then there's no money to pay taxes left on, right? So in this case, you made $100K, you spent $75,000 just like a W-2 employee did, but because of the way you're taxed, right? When you're taxed, your tax bill is way lower. In this equation, you save an instant $18,750 just because you're on the winning team, just because the tax code is made for business owners to incentivize us to take deductions. So that's high-level overview. And to break that down for those of you who knew, it's a a quick phrase, is if you're a business owner, you pay taxes on what's left, not what you make in the door initially. So that's where we at with that, right? So that's high-level overview, right? Now, part of this presentation is I'm going to break down business entity structures, right? It's four structures I'm going to hit on, but I want to start off with this one, right? Everybody by now they've heard of LLC, right? LLC stands for Limited Liability Company. The problem is a lot of us, and before this question even get asked, a popular question is, do I need an LLC to take business tax deductions, right? To take tax deductions. And the truth is, and I'm gonna add on to this later, so don't cancel me for this. You do not need an LLC to take business tax deductions. So I think it was Chris in the chat that said you don't have an LLC. Best believe that you're able to take the same exact tax deductions as anybody in this chat that does have an LLC, right? So you do not need an LLC to take business tax deductions, but you do need an LLC to, one, protect your wealth, right? You need it to protect your wealth because a lot of us out here, we're working, we're new small business owners. We're out here trying to build an enterprise, and there's no point in making a bag if you can't keep it. So one way to easily protect your wealth is by incorporating your business, and I'll elaborate on it on the next slide, by forming an LLC. So that's one reason why you should form an LLC. The second one is it enhances your credibility, right? Imagine if I was just a random guy doing taxes, right? Who would you go to in this case, right? The random guy that's just doing taxes, or the person who went through the whole process, got their business incorporated, got their license, and went through the whole process, right? And the reason why I say that is just because having an LLC helps enhances your credibility, right? Not only does it show your family and friends that you're serious about what you're doing, but those who are in the industry and marketing their business, it makes it a whole lot easier to market your business as well as build credit, right? Because once you get an LLC, and I'm gonna elaborate on it soon, now you're able to set up a business bank account and start establishing business credit, right? As a sole proprietor, you can't really do that. So you LLCs, the reason why you form is to protect your wealth, enhance your credibility, and to build credit, and lastly, for S-Corp insurance. You don't need it for tax deductions, but you need it for significant tax savings, right? So that's just high-level overview of LLCs. But now I'm gonna walk you all through the journey of where everybody in here is pretty much at in their phase of their business, right? Number one, if you decide you got a business today, right? I always say I just started a cup business 2 seconds ago. I'm a sole proprietor. I didn't register this business at the state level, but I'm taking a deduction moving forward for it. But when I'm getting that, anybody, everybody here, when you first came up with a business idea, right? Before you even incorporated your business, you started off as a sole proprietor. Everyone starts here. And the reason why is it's 100% free. It costs $0.00, right? And you don't have to register at the state level. So those of you here that don't have an entity registered at the state level, don't have an LLC yet, you can still take tax deductions, right? You're a sole proprietor. The only difference is you have no legal protection. So if you're in an industry where you're able to get sued, or I always use a rental property, for instance, you got a rental property and it's not in the LLC and somebody slip and fall, not only are your personal assets at risk, right? Your home, your car, your kids' savings, everything you didn't thought you did save, but now your business is also at risk too because you're a sole proprietor, right? So it's easy to set up. I recommend everybody to start there. I started there on day one, but the moment you take your business seriously, or the moment you start making money, that's when I recommend you to incorporate your business for an LLC. And the LLC, like I said, stands for Limited Liability Company. Everybody done heard of it now. It is the most popular and relatively inexpensive entity setup, right? If you got a business, I highly recommend for you to do this. In the state of Illinois, it's a $150 fee to get started, and it's a $75 annual fee, which in my case is relatively cheap, as long as you set this up the right way, because what it's going to do is it's going to protect your personal assets. Yes, you have to register at the state level, but it protects your assets. So in the same example, somebody slip and fall in that rental property or in your business, right? You got a Toro business, or you got a tax business, or you do lashes, right? You got a cosmetic business, and something happens, well, they can only take your assets within your business. They can't come at your personal assets, right? So just keep that in mind, right? So LLCs is the go-to, the starting point. The only thing I want to put heavy emphasis on is a lot of us form LLCs and we forget that it stands for Limited Liability Company. Now, in order to, from a legal standpoint, in order to get that limited liability that we sign up for to protect our wealth, we need to remember rule number one, which is what it does is it requires you to separate your business and your personal finances. We're going to talk about bookkeeping later, but a lot of us have LLCs and we're not separating things. So you form this to get liability protection, but if you were to get sued and you only got one bank account and all your business income and personal expenses, personal income is flowing in and out of one account, well, if you were to get sued, there's no way for the state to figure out this was your business assets, this was your personal assets. So guess what? Everything's back on the table. Everything is back at risk. So that's one thing to keep in mind. Please separate your business and personal accounts. We'll talk about that later. So you start off as a sole proprietor, you go to an LLC, and the next stage in life is the S corporation, right? An S corporation is not a new entity. It is a tax election status. It is basically somebody who already has a corporation or LLC set up, and they elect to be taxed as an S corp, right? So that's just one thing to keep in mind. The reason why an S corp is important because it's a tax saving machine. Now, everybody here don't need an S corp, but the moment your income is north of, let's say $50,000, I'm gonna up the number this year due to inflation. If your net income minus all your expenses is net of $50,000, then you need to be elected to be taxed as an S corp. And here's why. You see, as a business owner, you pay federal tax, state tax, and self-employment tax, right? We all know what federal and state tax is. Now, self-employment taxes, that's Social Security and that Medicare tax, right? That's FICA taxes. If you got a W-2, you see that 15.3% or half of that leave every time. Well, as a business owner, you have to pay that too. So if you're a single member LLC owner and you made $100,000 in net income, well, you have to pay an instant tax of $15,000 just because you have a single member LLC. But when you elect to be an S corp, you don't pay self-employment tax on your net income. Yes, you have to pay yourself a reasonable salary, and I'll say that for another time. But the vast majority of people with an S corp, if your income is north of $50,000, that's when you start seeing that significant tax savings. So I just wanted to point that out. The last one is C corps. I personally don't think anybody here needs a C corp. The only reason why people get C corps, yes, personal liability protection, right? As you can see, that's the trend everywhere, right? However, C corps are reserved in most cases for larger corporations, right? That's your Apples, that's your Googles, that's your McDonald's, your Pop, all these restaurants and these larger corporations, right? These banks, they are corporations. Why? A lot of them need to raise money on the public through the stock market, right? And they have to set up their entity a little differently, and some of them are even required. So if you're not a large corporation and you don't plan on going public with your firm in the near future, then I say stay away from C Corps, start off with an LLC, and then we can kind of restructure down the road. But that's big picture of like business structures. We can dive into in the Q&A, and the Corporate Transparency Act is going to tie into this a lot, especially if you have an LLC or a C Corp, but I just kind of want to give you a high-level overview. So now we went over taxes. Now we went over business entity structures, right? So we know how to make the bag. Now I'm going to teach you how to keep the bag, right? By essentially being able to take these write-offs to offset your income, right? So what is a tax write-off? So a tax write-off, right? The tax code is 70,000 plus pages, y'all. Have I read all 70,000? A decent amount, right? I will over time. But big picture is the tax code is 70,000 plus pages, and most people think it's 70,000 plus pages of teaching you how to pay taxes. But if you pay attention, the tax code is 70,000 plus pages of teaching you how to legally avoid paying taxes. The tax code is an incentive system, right? It is a rule book, a legal rule book to teach you how to legally avoid paying taxes, right? There's a reason why the wealthiest people in here don't pay taxes. It's because they understand the rules. And rule number one is that in order to win the game in taxes, you need to understand the rules, right? So that's where I'm getting at here. So when you look at tax deductions, the way it works is within that 70,000 pages of code, there's one section in there that matters to everybody here, and it's code section 162A. Now, code section 128 basically explains what a write-off is, right? And if you've been here before, you know exactly where I'm about to go with this, but it's anything that's ordinary and necessary to operate your business, right? And I just want to make sure y'all waking up. Can anybody put in the chat, like, who gets to determine if an expense is ordinary and necessary to operate your business? Is it your mom? Is it your dad? Is it your business partner? Is it the IRS? Like, anybody want to take a guess? Like, who determines if an expense is ordinary and necessary? I see business owner, you, me. Okay. All right. All right. Now I'm going to read somebody comment. More knowledge, more power. Look, y'all already on it, right? So it's up to us to determine if something is ordinary and necessary to operate our business, right? Now, this isn't me saying, hey, I need a private jet. No. All right, you're reaching, bro. You may be able to justify that by some type of rule, but what I'm getting at is that if it's ordinary and necessary to operate your business, and this when the mindset shift get in there, then it's a write-off, y'all. We're writing it off on our tax return. Remember I said, if you're making $100,000, you don't pay taxes on $100,000. You pay taxes on $100,000 minus all your ordinary and necessary expense to operate your business, and then you pay taxes on what's left. So that's a write-off, right? So what I'm gonna do is I'm gonna show y'all all some of my favorite write-offs, and for the next 10 minutes, I'm gonna break down some of my favorites, right? So this is a whole list, right? You got auto expenses, advertising, meals, insurance, legal fees, internet, website design, rental property. The list goes on and on and on and on. I'll send all of you this, but this is just some of my favorite. I want to say my top 20, but there's 1,000 more. Now, there's not 1,000 more for everybody. It's kind of tailored towards your industry, but big picture, I'm gonna let y'all look at this for a second. These are some of the main expenses you can take as a business owner, right? And I highlighted 3 because I want to kind of pick on those a little bit as everybody here is in different phases within their business. Number 1, startup costs. A lot of times we think that we need to have a profitable business to be able to take expenses. And I'm here to tell you, no, not at all, right? The way it works is, as long as you have the intent to make your business profitable, you can write off your startup costs, right? That's your legal fees, accounting fees, the marketing strategy, the training, the trips that you take, the education material you invest in, right? All of these different things you have to invest into your business, right? All of those startup costs are deductible in the first year of your business and throughout the journey of your business. See, the way it works is, as long as you make at least $1, right? So that you made at least $1 in profit, you can take all the expenses in the world to write off on your business return in the first year, because it's normal to have a business with a significant loss in the early years. Now, if you just started a business and you didn't make no money at all, you're like, the year is over, I can't take that many expenses on my tax return. Remember that there's a $5,000 rule. So if you're in startup mode and you didn't make no money at all, you can write off still up to $5,000 in expenses. And if you're in startup mode and your business, your only source of income, 9 times out of 10, you got a W-2 job or income coming from somewhere else. So that $5,000 loss will be used on your tax return to offset your W-2 wages. And that would kind of create a refund to put more money back in your pocket to reinvest back into your business. So that's just keep in mind. You can write off startup costs. If you have a loss within your business in the first year, that's perfectly fine, especially if you made money. Just remember to document the process, but startup costs are deductible. The second one, travel. It gets missed all the time, y'all. And I don't travel now unless I can figure out a way to make it tax deductible, right? Every trip I took last year, I wrote it off on my tax returns because I did something business related, and I'm gonna teach you all how. So when you look at travel, travel is deductible anytime you do anything business related outside of your main city, right? And there's 3 ways that I'm gonna hit on. We're gonna do 4 ways. I'm gonna give y'all one more. 4 ways that you can be able to deduct travel. First of all, when it comes down to travel, you can deduct the hotels, right? The Ubers, right? Yeah, I know when you travel and you ain't got no, or you get a rental car, right? Transportation, you can write those things off, right? Flights, meals, anything associated with that travel when you're not at home, that becomes deductible now. But the question is, how can I make this trip deductible? That's a great question. No, that's a good question. So the way it works is, one, meet with a client. That's pretty straightforward, right? If you got a client, a lot of my clients are, I'm in Chicago, right? All of my clients are spread out over the country. My main clients are in Texas, DC, Atlanta, and Minnesota. So anytime I leave this state to go there, I'm figuring out a way to meet with them so I can make that trip deductible. But that's the first way, meet with a client. The second one is attend a business conference. I attend a conference once every 3 months. I've been in Miami, Atlanta, Phoenix, and every time I go, I'll attend a business conference. And because I can say that the intent of that trip was deductible, now I'm able to write off that trip. And sometimes if you structure it the right way, you can write off the weekend expenses too as well, as long as you stay until that Monday and do something business related. And then the last 2 is my favorite. One, you can work anywhere around the world, anywhere around the country, especially if you have a virtual business. And as long as you work 4 hours a day, 4 hours a day, y'all, during the week, that day is now deductible for your tax returns. And lastly, board meetings, right? See, when you look at large corporations, they be having all these fancy retreats and trips and stuff like that all over the world, right? They got the money to do it, yes. But look, y'all, we got to think big. We're business owners. It don't matter how much money you make. We can take board meetings. We can definitely pick our board members, right? Which is required when you set up your entity correctly and say, hey, y'all, we're going to take a trip. When you take that trip, we talk about business. We're going to talk about my income and expenses from 2023. We're going to talk about my goals for 2024. And then we're going to do some team building exercises, right? And that's how you make a trip deductible, right? So those are some quick ways. Just remember, y'all, that when it's time to file your tax returns, a lot of times people miss this one. But this one, I want you to dive deeper and be like, I had a few trips. Did I do anything business related during those trips? And if you did, let's figure out a way to at least prorate that trip so you can take some of those deductions on your tax return. So that's that. Startup cost, travel, and the last one is retirement, right? And the truth is, I'm gonna take some water. A lot of us, when we leave our corporate jobs or just in general starting your own business, it's scary at times because you lose out on your benefits, right? You lose out on your health care. I've been there, right? You lose out on your retirement. I've been there, right? You lose out on a lot of benefits that W-2 employees get. And what happens is it kind of puts those, I don't say handcuffs on you, but it makes you a little hesitant to leave. And then when you leave, sometimes, especially speaking with my core clients, you kind of feel bad because you're not feeling like you're doing enough. But what I'm telling you all is that not having a corporate job, right, kind of puts you in a better position, because the truth is, as a business owner, you now have more options, right? Not only can you write off health insurance as a tax deduction directly to offset your business income, but you can invest a lot more for retirement, right? And I know it's a financial advisor here who can elaborate on this, but you can put up to $7,000 in an IRA account. And then for last year and this year, right? Last year, you could have put up to $66,000 towards a SEP IRA or solo 401k, right? Not only are you getting a tax deduction for that amount, but now you're able to build wealth 10 times faster than the average American because you're able to contribute a lot more towards your retirement account, right? So just keep that in mind, y'all. And it's a tax planning tip. I know the year is over, but with a SEP IRA, you have until you file your tax returns to set this account up. And if you have a profitable business, you can contribute up to $66,000 towards it today and still get the deduction on your 2023 tax return. So just keep that in mind, that you are able to write off retirement. There's phase outs for all this stuff, but I just want to kind of introduce you to these right here. So hopefully that makes sense right there. And the next thing I want to go over really quickly is some daily expenses, right? See, a lot of us convert to being a business owner, right? And we forget that a lot of our day-to-day expenses immediately become deductible the moment you're a business owner, right? See, if you're W-2 employee, you don't have a business, you're not writing off your phone bill, your internet, your meals, right? Your travel. But the moment you become a business owner, right? But the moment you have a hobby or something you love doing, right? I got some artists here, I got some bloggers here, podcasters. The moment you say, hey, I'm gonna make this profitable with the intent to make it profitable, now a lot of your day-to-day expenses immediately become deductible. And I see these get missed on TurboTax all the time when you do your taxes on your own. So if you're doing them on your own, pay attention and just make sure you're writing these off, because this stuff adds up quickly. Phone bill, internet. For me, I'm a virtual business owner. I need my phone, and my phone just rang 2 seconds ago. It's probably a client, right? I need my phone and my internet to be on at all times, and I'm pretty sure you do too, right? You need that on. It's ordinary necessary to operate your business. That's a write-off. And I don't know about you, if you were T-Mobile or Verizon, that phone bill north of about $1,500 when it's all said and done, plus internet, yeah, that's about $2,000 in expenses. And then you got meals, right? One hack to that is if you hire your friends and family within your business, every meal you have is now deductible. All of my friends are on my marketing team, and every time I go out to eat with any of my friends, best believe I'm pulling out the Amex, because at some point we're talking about Canva posts, Reels on IG, and how I can become a better business owner. So that's one hack right there. Meals are 50% deductible. So if you spend meals, you spent $10,000 on meals this year, you can only write off $5,000. But just keep that in mind, that if you're having a meal, even with your spouse, right? I'm not married, but I can only imagine that if you're a business owner, that's going to come up as a topic during the conversation. And if that's a topic, document it. Y'all take a picture of that receipt. Be like, yeah, we talked about goals for the business this summer. And that meal can potentially become deductible. But I just want to kind of bring those three out to you. We already talked about travel. And then the last cool ones, right? Apple Watches, MacBooks, computers. Let's just get creative with the fact and think about that there's different ways that we can take these expenses. See, a lot of times we hear deductions and we think, oh, I got to buy this random car. I got to buy this random trip. No, this is just me saying that a lot of your day-to-day expenses immediately become deductible the moment you are a business owner, right? And the last two I'm gonna hit on here is rent and car, because I feel like those are two basic ones, but there are questions that I get all the time. So if you are a business owner and you work from home, a reminder that a portion of your rent can become deductible, right? So the way it works is, it's either you take $5 per square foot, right? I'm in my home office. I'll take the square footage of my home office compared to my home, and I get $5 per square footage up to a $1,500 deduction. That's the easy route, right? That's cool. But if you live in downtown, or you live in some of these expensive states, or if your rent is super high, you can actually write off a portion of your rent. You will take the portion of your home for your business and compare it to the portion of your home. So if my home office is 300 square feet and my home is 1,000 square feet, right? That's 30% of my home being used for business purposes. If that's the case, I get a 30% deduction for rent, gas, water, lights, you name it, everything, right? Utilities as a bundle, repairs, landscape, everything related to your home now becomes deductible in your tax return. Why? Because you work from home. So keep that in mind. And the same thing with cars, y'all. A lot of us, we drive around all the time. I know tracking mileage is very hard, but I just want to remind y'all that last year you can get up to 65.5 cents per mile for driving your car. And I believe this year went up to 67 cents. So I want to keep y'all in mind that if you're driving to go meet with a client, you're driving to the store, you're driving to these events, anytime you're in your car, let's get in a habit of documenting those business mileages so you can get a tax deduction there, right? And it's the same thing with the car in the sense where you can take the simple way and get a deduction per mile, or you can write off actual expenses related to the car. You don't get a deduction for like the car note necessarily, and I'll elaborate on that. But if you're using your car 100% for business purposes, or 75% business purposes, well, if it's 75% usage, you get a 75 deduction for oil, gas, repairs, tolls, car washes, right? Them fender benders, all these expenses that come up with your car. If that's your business car, remember that you can deduct that. But in order to do so, you need to keep track of your mileage. And this is just me being honest. Keeping track of mileage is one of those things where a lot of us forget. So, assignment for everybody here. If you have a business and you have a car, let's go outside. If it's snowing, stay inside. We can do it tomorrow. Take a picture of your odometer today. Because what happens is, if you were to get audited because of mileage, what they check for is they want to make sure that you actually drove the amount of miles that you rode. So, Nick, since you're on the screen, Nick said he drove 10,000 miles last year. But when IRS audits him, knock on wood that they don't, they will say, okay, let me see your oil change from January and let me see your oil change from December. And when they see that paperwork, they see, oh, Nick only drove 6,000 miles. So where the hell did he get these extra 4,000 miles? Red flag. So one way, I know tracking mileage is kind of hard, but what I recommend for all you now, track your mileage. But if you got a car and you got a business, take a picture of that odometer today. get that mileage and do the same thing at the end of the year and then track your miles throughout the year. Because when you got a business, and we're going to talk about it in a minute, it's all about creating that paper trail, y'all. Just so if the IRS ever came knocking, that can definitely get to you. Not get to you, you'll have all the legal protection that you need. So that's deductions. We can dive into those forever, but I want to switch the topic up a little bit just because I promised to talk about a little different topics today. Number one, estimated taxes, right? By show of hands, and I'm curious, who made estimated taxes this year? I want to be nosy. Somebody put a thumb up. Let me see. If you made an estimated tax payment this year, let me see. Any thumbs up? Let's see. I want to see. I want to see who in the room now. I ain't seen nobody in a second. Let's see. All right. I hope somebody here made an estimated tax. I was okay. John, thank you. You scared me, bro. I was like, nobody made an estimated tax payment. All right. Okay. All right. That gives me some hope, right? One person here made an estimated tax payment, right? It makes two of us. So a lot of times, right? And I'm gonna fix y'all's screen real quick. A lot of times, estimated tax payments get overlooked as a business owner, right? And I'm gonna try to hit on this and explain it the best way possible. Like I said in the beginning, if you're a W-2 employee, you make money, the IRS takes money, and then you get to spend what's left. Now, the beautiful thing about having a W-2 job is that not only is the income stable, but you don't have a tax problem 9 times out of 10. You still paying taxes, but you don't really have a tax problem. And the reason why is because taxes are already paid. So when they file their tax returns next month, they'd be like, okay, you owed us $22,000, but you already paid us $24,000 throughout the year every 2 weeks. So now you're getting a refund of $2K. But business owners, boy, this is what messes majority of us up, right? We start having these profitable businesses, right? And I'll talk about bookkeeping in a minute. We start having these profitable businesses and we're not tracking expenses, which is another story. But what happens is we have this profit on our tax return, and then tax time come around, we owe this fat tax bill. And then I'm trying everything in my power to help reduce the bill in February of 2024, but you were really supposed to reduce your tax bill in 2023. But that's another story, right? But what I'm getting at is best practices for business owners is if you have a business, we need to get in the habit of saving money away for taxes as if we were Uncle Sam. And what that basically means is that we need to set up a whole separate bank account. It don't need to be a business account. It don't need to be a savings account. It can be a random account at Fifth Third Bank, right? And every time you get paid, you need to get in the habit of putting 20 to 25% of your income up into a separate tax account. You get a $10,000 check as commission as a realtor. Before you go splurging and celebrating, I need you to put $2,000 up into a separate account. And realistically speaking, and just being honest with y'all, that's hard, right? It's kind of hard to, the whole point of having a business and coming to webinars like this is so you don't have to pay taxes. But hear me out. You want to get in the habit of putting something up. I recommend 20 to 25%. I already told y'all your tax bill is going to be 30 to 40%, but get in the habit of at least putting 20% up. Because what that's going to do is, as a business owner, you're not required to pay taxes every 2 weeks. You're required to pay taxes quarterly. So April 15th, June 15th, September 15th, at the end of the year, these are the dates for next year, but ideally it's the same date every year. And by you saving for taxes every time you get paid, when it's time to make these quarterly estimated tax payments, you already have the money saved. That's the whole point of it. And if you make an estimated taxes throughout the year and you've been owing $10,000 the last few years, when tax time come around, you may not owe nothing at all. Now you don't have to worry about setting up a payment plan. Now tax time isn't as less stressful. It's less stressful because you've been proactively saving for taxes throughout the year. So estimated taxes is super important. Let's get in the habit of saving money to a separate account. Make these quarterly payments. There is a penalty. It is very small by all means, but those penalties add up, right? Some of us still paying credit cards from Christmas. That can be toward the gifts. But what I'm getting at is business owners, you do have to pay taxes. It's just quarterly. You're in charge of your tax bill. And the last thing on this is, remember I said, you don't pay taxes on your revenue. You pay taxes on what's left. So if you're making $10,000 and you get in the habit of putting 20% up, but after all your expenses, you were only supposed to pay taxes on 4K. Well, guess what? Congratulations. You oversaved in taxes. So now you're able to make those estimated tax payments with no problem. And as your business grows over time and you start generating more income, you already got a tax nest egg emergency savings saved up. So now you're able to make that tax payment. So that's something to keep in mind, y'all. Living legally tax-free and avoiding taxes is the plan. But sometimes you need to pay to play, right? You need to show income. You want to get a rent, you want to get a rental property, you want to get a home. They look at our tax returns as business owners. And that's what they use to determine if you have a profitable business and if you can afford a mortgage. So get in the habit, y'all, saving for estimated tax payments. And then that's the way to go. I don't want to talk y'all ear off too much. We can open that, but that's big picture, y'all. Estimated taxes are important. The last one, and I'm gonna try not to go on this topic too much because this is one of the biggest problems, y'all. The biggest problems that business owners have. It is bookkeeper best practices. You can take every deduction in a book, every single one of these, but IRS come knocking and you ain't got a single receipt, or you ain't got a bank statement, or you ain't got a financial statement, or you ain't got the record keeping. Oh, best believe not only are you gonna have to pay them back that money you said you got a refund, you about to pay them what you would have owed, but now you're getting paid, you got to pay penalties and all these additional fees as if you committed fraud. We don't want to do that no more. So the key to maximizing your tax deductions is to stay organized, y'all. That's my number one advice. You got a new business, you about to get into this venture, right? Get as organized as possible, y'all. Bookkeeping is the one thing that's overlooked. And then January hits, February hits, tax time hits, and now bookkeeping all of a sudden is important. And that is a headache, y'all. Not only is it very expensive to clean books up because it's time consuming and it's a tedious task, but it makes your life 10 times harder. So I'm gonna give you all some tips. Tip number one is Excel is perfectly fine, right? I know we got some Excel users in here. I've talked to like 3 of y'all this week. Cheers to Excel. I started off with Excel when I first started my business, and I'm proud of it, right? Because it's easy. But what it did was it got me in the process of keeping track of my income monthly and then all of my expenses. Because a lot of times we have these businesses, and I'm always gonna bring it up. We making $90,000 in a year, but when we finally look at our expenses, we had a business loss. Like I spent that much money. That's always the reaction. So that's one thing. Excel is perfectly fine. But what I recommend for everybody here is use Xero or QuickBooks. QuickBooks is always my favorite. It's like $20 to $30 a month, depending on how many accounts you have. But you literally link your business bank account to QuickBooks. All right, everybody here, especially if you have an entity, remember you need to separate personal and business finances, but you link your business account to QuickBooks and you just categorize your transactions, y'all. If you went out to eat to McDonald's, they gonna know it's meals. It's gonna be meals. If you went to Menards, you got supplies. They gonna know it's Menards, right? It's gonna be supplies. The same thing, vice versa. If you travel Delta or something like that, it's gonna pop up as flight. The only thing you have to go in there is categorize, like, yeah, that was meals, that was supplies, etc. Now it's easier said than done because if you make a few mistakes, your books are back messy, right? So I always recommend at least hiring somebody or going to Fiverr. Like one of the two. Fiverr is extremely cheap for literally anything you need, from virtual assistants to creating reels, all the way to bookkeeping, right? Anything you need, Fiverr, y'all. So that's why I want to get at there. You need a bookkeeping, right? What's going to happen is when it's time to get these deductions, a lot of times we can't accurately estimate your estimated taxes because we don't know your expenses. And as a business owner, best practice, and just from an ethical standpoint, y'all, like we don't want to be running these businesses and be sloppy with it, right? Not only does that translate to our work sometimes because it stresses us out, but it just makes it a headache, right? I hate to see it, but like this is one thing that I don't know how to express how I feel about it, but I just want to put heavy emphasis on y'all. It's a really small task, but it's the most important thing to track your revenue, to keep track of your expenses, and then to stay in best practices. And the last thing before I go to the last part of the presentation is if you're new to businesses, right, new to being a business owner, the rule of thumb with the IRS is that you need to keep receipts for at least 3 years, at least 3. And it's not like the older days where you need to keep receipts in the garbage bag and store them in an envelope. No, it's not like that. It's 2024 now, right? What happens is all you need to do is keep a physical copy. I mean, a digital copy. I used to take a picture, store it in an iPhone folder, or I got 2 phones. I'll text it to my phone, or I'll put it in my email. But you want to get in the habit of storing these receipts because if you get audited, or if you got a material expense, or you try to get a refund or something, you're going to need these receipts. So keep that in mind. Anytime you're taking expenses, document it and keep track of those. But that's bookkeeping best practices, y'all. The last part I want to dive into, right? This is a relatively new topic, and we're going to open the floor up for a Q&A because that's really what I want to kind of dive into. But this one is for the Corporate Transparency Act. And just out of curiosity, right? Have y'all heard of this before? Can y'all put thumbs up, thumbs down, just so I can figure out how I want to go about tackling this? Let's see. I got y'all faces pulled up. See a thumbs down. Okay. John, Nick, thumbs up. Anybody? Thumbs down if you haven't heard of this? Okay. Cool. Okay. All right. 2 of y'all, the rest of y'all, I hope y'all gonna hear about it soon. All right, cool. So the Corporate Transparency Act, right? And anybody in here, if you have an entity registered at the state level, wake up. This is the most important part here, because I will be very upset if anybody here failed to take action on this and now you owe the IRS $10,000 and then you're in jail. If you're in jail because of what I'm about to say right now, don't ask somebody to put no money on your books. This is not one of those situations. This is one of those things that's very simple. So, what is the Corporate Transparency Act? Great question. So, CTA. Now, this is relatively new. As of January 1st, 2024, it's the first time it hit the public, first time it hit social media. However, the Corporate Transparency Act was actually initiated in 2021. And not to read off here, basically, the Corporate Transparency Act is not to get us to pay the IRS or to get anybody in trouble, right? Not us, right? I hope not. But basically, it is the government's attempt to fight bad actors, right? People who've been hiding behind these entities, committing sex trafficking, drug dealers, scamming people, and all these ratchet things that you can do within an entity. The IRS and FinCEN is tied up. So FinCEN, who is the sister to the IRS, right? They work with each other. Like, how can we catch these people who've been doing all of these bad activities within LLC? Because if you hear me out, the way it works is if you register a business, if you register an entity, right? You register it at the state level. So Illinois know who you are, but the IRS never did. So if you were to get scammed or something were to happen, it was very hard to figure out who's been behind these LLCs because the IRS never had a database for it. So now FinCEN is like, we'll take charge. So FinCEN is just partnering with the IRS, right? They always work with each other, but now they have a private database where you're basically going to be required to report your personal information to this database. And if you don't, it's going to be a whole lot of fees and even jail time. But that's big picture, right? It's not to make anybody's lives harder, right? It's literally for us, the people who have ethical businesses and doing the right thing. They just want to know who you are, where you live, and that information, right? So who is required to file this, right? I know on social media, it's very hard to give you all a quick 30-second spiel. So I'm going to take my time with this and break this down, right? Who is required to file? Everybody here for the most part. I want to say the vast majority of us. Who? If you got a corporation, you got an LLC, so a limited liability company, right? Or if you file any type of document, a DBA or some sorts at the state level to register your business, you're required to file this. Now, there's 23 types of entities that are exempt from filing this. And as you can imagine, mostly corporate America, right? You got the banks, the credit unions, the public accounting firms, the larger corporations, right? Tax exempt organizations. So if you have a non-for-profit, you in the clear, non-for-profits, all right? But what I'm getting at is there's 23 exemptions. But out of all those, I already did the research for y'all. It's only 3 that can potentially apply to anybody here, right? For the most part. Number 1 is if you have a large operating company with $5 million in gross receipts. If that's you here in this chat, first of all, thank you for coming. My name is Darion. No, if that's you in this chat, if you made over $5 million in your business, you're exempt. Why? Because if you're making this much money, most likely, and you got 20 or more employees, the IRS, they know who you are. They've been keeping track of you, so you're exempt, right? Now, assuming all of us aren't there yet, and we will be at the end of this year, right? The next one is inactive companies. You see, what I've noticed is a lot of times we create all of these entities. I know people, and no shade, right? Got 6, 7 LLCs, but only got 2 businesses, right? So what's going to happen is if you have an inactive company, a LLC or corporation that you haven't used prior to the pandemic, see, what really pissed the IRS off was when the pandemic came around and the PPP loans and these ERC credits and all that stuff. That's when the IRS was like, all right, we need to figure out a way to stop this. So they like, if you had an entity before the pandemic in 2020 and you haven't used it at all, no income in terms of $1,000 or more, like using the accounts, you may be exempt from filing this. So the first thing I would do is if this is you, right? And this is a relatively new topic, right? I got a Q&A session, FAQ list that'll help you all, and I can break this down in the questions at the end. But if you have a business that's been around and you haven't used it, what I would do is I would, 1, check at the state level to see if your business is active. That's the first level. You got a business like, I formed it in 2018. I ain't used it in a couple of years. Let's not leave this in God's hands. Let's just figure it out on our own, right? So that's first step. Check on the Illinois website, check with the Secretary of State and see if your business is active. If not, you're in the clear. If it is, or if you don't see it, still fill out this form. But long story short, if you have an inactive company, you may be exempt from this. The second one is the sole proprietors. And I broke this down in the beginning. right? As a sole proprietor, you can take the same tax deductions as a single member LLC. However, you aren't registered at the state level. You have no limited liability protection. Therefore, whenever you file your tax returns and get a 1099, you're not putting the EIN, you're putting your social security number, right? And because of that, the IRS knows who you are. If you start filing a legal agreement or something that requires you to put your business, well, you are your business. So as a sole proprietor, you don't have to file this. And what does that mean? If you don't have an LLC set up, you don't have to file this form at all. But the moment you set the LLC up, that's when you need to file it. So that's who needs to file, right? Now, who needs to file, right? Who needs to file is anybody who's a beneficial owner within the business. That's why it's called a BOI report, a beneficial ownership information report, BOI. So if you exercise substantial control, right? If you were CEO, CFO, president, the main manager within your business, you have to file, right? That's number one. If you are somebody within the business, you can have the authority to make massive changes, that's you, right? Or if you have substantial influence, and what I'm getting at, y'all, most of us with these small businesses, right? And it's a beautiful thing, but we are the manager. We're wearing all the hats. So if this is you, you need to fill this form out. The second one is more for the larger companies, but I'll put it here. If you have 25% ownership in the company, right? And in some cases, some of us have partnerships where we are limited partners, meaning we only invest or we own less than 10%. This may not include you. But if you have a profit interest, capital interest, or you own stocks within the company and you're more than 25%, you got to file this. So this is pretty much everybody here by the sounds of it. I just wanted to put that there. The last one before we open this up to Q&A, what do you need to file? So before I start, y'all, and I might get hated out on this one, is this form is 100% free. All right? I will get canceled. There's people out here charging $500 for this form, $150 for this form, $300 for this form. And because all y'all came here, I'm going to tell you exactly what I know. Don't pay nobody to do this. You do an annual report every single year, it's almost as easy as that. Annual report, if y'all done it, it's literally, hey, this is my business. I'm in good standing. Pay your $75, go. This one is 100% free. They just want you to say, hey, what's your business name? Wiggs CPA Tax and Accounting. If you got a DBA, put that. What's your address? What's your EIN? Okay. All right. Now, if you're a beneficial owner, if you're one of these people right here, you're a CEO, your ownership interests, etc., if that falls under you, well, this is when it gets interesting. And this is when anybody who's been committing fraud, and these are the people who you're going to get caught up at. Well, they want your name, they want your date of birth, and they want your residential address. But that's not it, y'all. They want a physical picture of your ID. Now, pause, because that can create some barriers, right? Because a lot of us are even got the same address on the ID as our business, but it's not about your business, it's where you physically live. Because the whole point of this is to figure out where you physically live as the owner, just so the IRS can keep track of you, right? So that's something to keep in mind. That this is very simple. I did it yesterday because I hate talking about stuff that I actually don't do. It took me about 4 minutes, and that's because I was documenting the whole process, but it could take you 3 minutes to take care of this. And I already added the link in the chat. Scroll up to the beginning. I'll send it later. But this can take 5 minutes and fill it out, right? That's all. We can talk about it in a minute. So it's super simple. Don't pay nobody to do it unless you have like a entity structure where it's complex with a bunch of partners. It's owned by different entities, and it has a bunch of different layers to it, because then that creates problems and you may need to pay somebody to do it or a consultant, right? So I just want to put that out there. But the vast majority of us, we can knock this out today and won't have to worry about it. So when do you have to file it? If you have an entity set up prior to 2024, right? You got a business that's been set up from 2020 to 2024, right? And it was active, you have this entire year to fill it out. You have until January 1st up until, we're just going to say, and we're going to say Christmas. I'm going to give y'all a deadline because I know sometimes we'll be on CPT time. So Christmas, have this form filled out before Christmas of next year. All right? That's the deadline we're going to go with. So, and I took this exactly from the website, so I don't get nothing wrong here. So if you have an existing company, you have the whole year to fill it out. I still recommend to fill it out today, but you have the whole year. Now, this is when it gets tricky. If you have a new business, right? And I'm Chris, not to pick on you again. I know you say you set up an LLC this year. Because you're setting up an LLC this year, well, you only have 90 days to do this. See, back in the day, you could just set up your own LLC, use LegalZoom, pay somebody to do it so they can do it correctly. But don't forget about this part. If you set up a new LLC moving forward, you got 90 days, and that's just for this year. And then after that, you're going to have 30 days. So just keep that in mind that they're trying to get it down to 30 days, but they know that it takes time for us to kind of adapt to this. So that's just something to keep in mind, right? So look at this, take a screenshot, but the vast majority of us, if you have a business set up already, let's just take care of this week, all right? So now the last one, actually, before I go to that, I want to say the reason why this is important is it's not a one-time form, right? This is something that they're going to use to track you for the rest of your life. So the rule is anytime you move, anytime you change your business name, anytime your business address changes, anytime there's a new partner, anytime anything changes within your business that falls within the scope of this, right? Or this, you need to update that form every single time for the rest of your life. And you got 30 days to do it. Otherwise, these penalties I'm going to talk about, $500 fee, $10,000 fine, 2 years in prison, that kick in because now they think you hide. So every time you move, so a hack that I would do is I said fill it out today, but if you know you're about to move in April when your lease ends, you can potentially wait until May because then you ain't got to fill it out twice in a year. You can wait until your address is updated and then you can fill this form out. And big picture, y'all, the reason why they're doing this is because people have been hiding behind these businesses or working in different countries or different states and saying they got a Nevada entity or they live in Texas, but they live in Chicago or they live in Cali and they say they live in Delaware to get these tax benefits. Well, this is how they're going to catch people as well as people who've been committing fraud and crimes. They're going to be like, all right, if you want to keep running this game, well, you need to get a little bit more creative and prove to us that you're a real person by sending us a picture of your ID. So that's that, y'all. If you don't take care of this, congratulations. If you don't take care of this, where is this at? Because if you don't take care of this, congratulations, you done played yourself. Because if you don't do this, $500 fee per day, starting January 1st of next year, right? And let's say you big and bag, like, all right, I forget to do it, or, I'm going to tell you about this every month for the next 12 months. Y'all going to hate me. But it's a $500 per fee, per day fee. Then it's up to $10,000. And once you get to the $10,000 mark, you're going to jail now. That is the vision, right? And I don't think this is going to apply to anybody here, but if you've been hiding under your entity, you got about a year left before you're going into the pen. So this is important because I don't want anybody here to miss this step. It is very small, and I'm going to reemphasize, this is extremely easy to do, but now as a business owner, right, this is something that needs to be communicated to us as a community because we have to do this and we need to update this each and every single time. So write it down into your checklist, your game plan, but just remove it at every time that you move, every time that something changes within your business. On a serious note, y'all, please fill this out because having to deal with them, and especially with this act being new, like we don't know how for real they are about this. Like obviously some people may forget, or some people may have an entity that they haven't been able to get to, or they just forgot to do it, right? That's a dumb reason to go to prison, right? So there's going to be different rules, but I just want to kind of let you all know on a serious note, take care of this. Takes 5 minutes, super easy. If you have questions, the FAQ section on the website is better than Spark Notes, y'all. It is better than ChatGPT. It tells you everything you need to know. So that's on that, y'all. So lastly, because I do want to open the floor for Q&A, I just wanted to add that in there, is business owners, right? So last minute tips is don't wait until February to start working on your tax returns. Start doing it now. And I'm not saying reach out to your preparer today. I'm saying this is the best time to start reviewing receipts, reviewing bank statements, and getting those tax returns ready to go. Because if you're a business, we're going to ask for your profit and loss statement. Wow. And that's your income and expenses throughout the year. That's going to be the number one thing that we're going to need. So that's the first thing you need to do. If you need a bookkeeping cleanup, it's going to be expensive only because of the fact that you need to clean it up for the entire year. We help with that, but I'm going to keep it a buck with you. If you got a small business, going to Fiverr is probably your best bet, and finding one of these freelancers to kind of take care of it for you, and you're going to be in good hands with that. And then, now that the year is new, that's when it's time to invest in a CPA or services like myself or another firm or just a bookkeeper so that you can have your books cleaned up every single month throughout the year. So when tax time come around, you're not having the same problem. So tip number 1 and 2 is review your bank statements and get those receipts together. If you have a small business, you need to do that right away. Lastly, IRS transcripts. A lot of us don't know what that is, but if you don't know how much money you receive, W-2s, stocks, cryptocurrencies, 1099s for your personal name, you can go to the IRS website, pull your transcript, and they know how much money you received for the year. And lastly, if you have W-2 employees, or 1099 contractors, make sure you issue them a form by January 31st, right? If you don't do it, you will be penalized. It goes from like, I'm gonna make these numbers up just to exaggerate them. It's like 150, then it's like 500, and then it's like 1,000. It's like a huge jump from 1 month, 2 month, 3 months to the end of the year. So you definitely want to file this, because not only is this best practice for business owner, but your employees are counting on this, right? They may need a mortgage. They need to justify their income. They may need the W-2 so they can file their tax returns and get their refunds. So keep that in mind. That's due. The last things is the key deadlines. The IRS just announced yesterday that they are accepting tax returns as of January 29th. I don't know what date it is, but I believe that is 20 days from now. That Monday is when the IRS is accepting returns. If you have a business, a lot of people think that your tax return is due March 15th. That's not always the case. If you have a partnership or an S Corp, your tax return is due March 15th. And the reason why is because you need to file your business tax return first for informational purposes, and then you will get a K-1 that will show your portion of the income that you need to pay taxes on, and then you file your personal tax returns. So let's prioritize your business tax return first. And if you have a single member LLC, a C Corp, you're a sole proprietor, all of that is due by April 15th. So that's just something to keep in mind. And just remember that if you file an extension, you get 6 months to file your tax returns, but that tax bill is still due April 15th or March 15th. So that's just something to keep in mind, y'all. I know that was a lot of information. I'm gonna open up the floor for Q&A, but I just want to thank you all again. I know that was a lot, and it looks like all of y'all kind of stuck around. So thank you, right? So please stay in touch, y'all. WiggsCPA.com is a website. That's my email and phone number. I'll reach out to all y'all, send y'all some resources. Definitely follow on IG. I just made the account a year ago. I try to post 2 to 3 informational videos every single week. And then lastly, y'all, feel free to reach out if you ever need help. We do taxes during tax season. We mostly focus on business returns, but for the next 2 months, we're filing returns. And then after that, we focus on working with small business owners within the service-based industry. So if you're a professional, you provide a service, and you at the 6-figure range, or you will be there, we can be your go-to person to handle your bookkeeping, the payroll, the tax planning, the tax prep. And now we're sitting down with you strategically throughout the year to help you reduce your tax bill, because there's 2 different types of tax season. There's tax paying season, which is what we're all in now. That's when you pull up to your preparer, you give them your W-2s, and we be like, hey, this is how much you owe in taxes. That's tax paying season. But if you're really trying to strategically reduce your tax bill, you need to enroll in tax planning season. And that's when you strategically work on implementing these different tax strategies to reduce your tax bill throughout the year. So that's what we help small business owners with. But yeah, that's pretty much it, y'all. Thank y'all. There's a lot of chat questions. I'm going to stick around and answer it. But thanks again for your time. And let's dive into some of these questions. Feel free to come off mute and feel free to, ask these questions. I'm all ears. And I'm going to unrecord this because I want the questions to stay here. Yep, and let's see, stop recording.